Good afternoon, traders. Welcome to this week's Thursday webinar session. So today we will be looking at trading the supply and demand zones in the market. So what are supply and demand zones? So these are areas on the chart where you will notice aggressive buying or selling activity happening, and they are high probability turning points where traders can easily identify high quality trade setups. They are characterized by formation of very long candlesticks within a very short range of time. And this is an indication that institutional traders were looking to fill their orders along that price level. So when you talk about supply and demand, these are areas that are marked by two horizontal lines. So as a trader, you'd mark these lines, and the intention is to use these levels, the point at which the market will come back to that price level, because at that price level, demand and supply is out of balance. So what happens is that we have two zones. We have supply zone and we have demand zone. But before we get to that, when we say that these are areas where you'd find an imbalance between supply and demand, when the price is balanced, it basically means that market participants are agreeing on price. And that is to say, equilibrium between buyers and sellers has been attained. And in such cases, you would notice that market would have a range or a sideways market. However, when there is an imbalance in the market, it is a case where you'd have participants not agreeing on the price. Demand would be exceeding supply, or in some cases, you'd have supply exceeding demand. And this would therefore create an illiquid area of price. And since all orders were in favor of either sellers, or to a great extent, orders could be way much in favor of buyers, you therefore find that there is sort of an imbalance in that zone. So we therefore look to establish instances where we've had such imbalances in order to mark our supply and demand zone. And by marking those levels, you will be targeting to see how the market will behave. You'll be targeting to see the reaction of the market once the price has come back to that level in the future. So that's the whole essence of marking supply and demand zones. So what is supply? Supply basically means price levels where sellers find opportunities to enter the market in huge volumes. So in this particular case, you'd have sellers perceiving the price to be great for them to float orders at that level, because they would consider supply zone to be a level where that asset is overbought. So by placing orders at that level, they are targeting to have a huge movement to the downside once the market begins to rally. On the other hand, demand zone is a price level where buyers find opportunities to enter the market in big volumes. So it's basically a level where buyers would perceive a price to be very great for them to enter orders or to float orders at a very discounted price. So what happens is that once the price begins to rally out of supply or demand zones, you'd have a very huge movement, and traders would target to try and establish how price will behave once we come back to that level in the near future. So what are the key terms in supply zone and demand zone in trading? So we have some key terms that we need to familiarize ourselves with. So the first term is extended range candlesticks. So when you talk about extended range candlesticks, these are long, extensive candlesticks that burst out of a demand or supply zone, and they tend to rally out of these zones due to the pent-up demand or supply that has caused huge orders, that has been caused by huge orders at that level. So as traders continue to accumulate orders along demand or supply zones, price will eventually burst out, and that will be marked by 2 or 3 long candlesticks. So in the case of supply level, you'd have 2 or 3 long bearish candlesticks bursting out of that supply zone to the downside. In the case of demand zone, you'd have 2 or 3 bullish candlestick bursting out of such a zone, and the price would then continue to rise higher and higher in the future. The other term is distal line. So distal line is basically the line that you would draw farthest from the current market price level. So this is the line that would be far away from where the current market level is. This line is drawn at the peak of the candlestick with the highest wick in the case of supply zone. So when you're on supply zone, you'd mark the highest point based on the wick of the candlestick that has extended quite long on the upside. So that line that you will draw on the upper side is what we are calling distal line. At demand zone, it is drawn along the tip of the candlestick that is on the lower side. So the candlestick that has the longest wick on the lower side along demand zone, that is where you place your distal line in order to mark your demand zone. The second line is called proximal line. So proximal line is the line which is closest to the current market price level along supply zone. It is drawn along basing candlesticks with the lowest level of body. So basically, before the market has formed these candlesticks, which you are calling extended range candlesticks, the candlesticks that come before extended range candlesticks, they are usually 2 or 3. So the candlestick with the lowest level in terms of body formation, you'd base your proximal candlestick along that level. So the candlestick with the lowest body, that is where you'd place your proximal line along supply zone. So we will get to see this practically so that you can have a deeper understanding of what I'm talking about. In the case of a demand zone, the proximal line would be drawn along basing candlesticks with the highest level of body. So you'd have 2 or 3 basing candlesticks forming along demand zone, and basic candlesticks are candlesticks that would be formed just before the price has formed those long candlesticks that we are calling extended range candlesticks. So when you look at basing candlesticks, you try to establish the candlestick that has the highest level in terms of body, and you place your candlestick along that level in order to mark your proximal line. Then we have candlesticks which you are calling basing candlesticks. So basing candlesticks are candlesticks that transition the market into a period of price rally. So they normally precede extended range candlesticks. So as I've stated, you'd have 2 or 3 basing candlesticks, and the fewer the candlesticks, the better the zone is, because it means that that level will be quite strong. So you don't want a level where you'd have multiple candlesticks concentrated along the zone. You just want to have the market coming to a level. It would form between 2 to 5 candlesticks before it has made the rally either to the opposite direction or as a continuation of the existing trend in the market. The other term is supply. So we say that supply refers to an increased pressure to sell, and this is caused by an imbalance where majority of traders have excess sale orders. When we talk about demand, demand refers to an increased pressure to buy along a particular zone, and this is mostly caused by an imbalance where majority of traders have excess buy orders lying along that zone. Then we have a few factors to consider before we identify high probability supply and demand zones. Remember, it's not just any zone. We want to have a zone where the market has stalled with a few candlesticks. Then that is followed by a very huge rally, either to the downside or to the upside. So some of the factors that you should consider when you're trying to identify high probability supply and demand zones are the strength of the bearish or bullish candlesticks out of the zone, or what we are calling extended range candlesticks. So extended range candlesticks need to first, so with the extended range candlesticks, the first sign is that a trader should expect to see at least 2 extended range candlesticks bursting out of a zone with a significant rally, either to the upside or to the downside. So once you see that burst in price with at least 2 or 3 candlesticks, then you'd know that indeed that is a critical level that you should consider either to be demand or supply zone. So if that level is a strong supply or demand zone, it will be characterized by such candlesticks. So basically, we want long candlesticks to burst out of that level for us to know that indeed the market is coming out of a demand or supply zone. So the second factor that you need to consider is the number of candlesticks on the zone should ideally be very few. So we are talking about a supply or demand zone to be very strong if the aggregate number of candlesticks that compose that zone are very few, and this would be between a minimum of 2 candlesticks and a maximum of 5 candlesticks. If you have more than 5 candlesticks, then it would mean that that level is not the most effective level to consider to be either supply or demand zone. So you want the price to come to that level, form around 2 to 3 basing candlesticks, then the price would burst with 2 to 3 extended range candlesticks out of that zone. The third factor to consider is that the number of times the zone is tested would also determine how you will trade that zone. So how many times has support zone or demand zone been tested? So an area can be retested more than one time. However, fresh zones tend to yield the best results. So it is therefore advisable to look for a fresh zone of supply or demand that has not been tested in order to have a very effective trade. So a fresh zone would therefore yield the best results. But this is not to say you cannot trade an area that has been retested. It just means that if an area has been retested more than one time, you're less likely to have very significant results. So if it is the first time, then the second time that level will be retested is likely to yield a very extended move, either to the upside if this is a demand zone, or an extended move to the downside if this is a supply zone. The last thing that we need to consider is how to place stop loss and take profit. So when it comes to placing your stop loss should be based on the distance between proximal line and distal line. So along supply zone, you're looking to place your stop loss a few pips above the distal line. So you'd be looking to place your stop loss a few pips above the line that is above, the line that we are calling distal line. If you're dealing with a demand zone, you'd be looking to place your stop loss a few pips below the distal line. So in the case of demand zone, your distal line will be the line at the bottom. So a few pips above the line, which is on the lower side, ideally that is where you should place your stop loss. Then when it comes to reward or take profit, you'd be looking to place your take profit along proximal. You will determine your take profit level based on the distance between the highest level or the lowest level of the trend preceding that zone. So ideally, reward or take profit should be based on the most recent trend preceding that zone. So you'll check backwards and look at the trend which has been formed before getting into such a zone. And you'd tend to measure the distance between the proximal line and the lowest level if you're dealing with a case where we were on an uptrend. But in a case where we were on a downtrend, you'd base your take profit based on the highest point and where the proximal line is. So we will get to see this as we look at a few captions that we have in the next few slides. So in this case, we have examples of a supply zone and a demand zone. So in this case, we have supply zone. So the line which is above, so this particular line is what we are calling distal line. The line that is below that is what we are calling proximal line. So in case of a supply zone, your stop loss should be based on the distance between distal line, the line above, and the line that is below distal line. So this is the line that you're calling proximal line. So you should place your stop loss a few pips above your distal line or this particular line. So along such a zone is where you'd tend to place your stop loss. When it comes to the take profit, when you are dealing with supply, you'll check backwards for the trend that was existing, and you will tend to place your take profit based on the range of pre-existing trend before approaching such a zone. So before manifestation of the supply zone, you will measure the range of the trend that was existing prior to that, and that the take profit would be the distance between proximal line, the lower line, and the extent of that range. On the other hand, when we are dealing with demand zone, we will have our distal line as the line on the lower side. So this is what we are calling distal line. This is what we are calling proximal line. So your stop loss should be below the line on the bottom side of demand zone. Your take profit should be based on the prior trend, the trend that was the trend that is preceding that particular zone. So the extent of that range is what you should use to measure your take profit. So the take profit can be the distance between your proximal line and the highest level of that range. To have more clarity on this, we have additional pictures. So this is an example of a supply zone. And we have four types of, we have two types of supply zones, and we also have two types of demand zones. So in this case, we are dealing with a case where you'd have the market making a rally. So initially you can see that the market was moving higher and higher. Then when we got to this particular level, you will notice that we had a very significant burst in price. So these candlesticks are signifying that price was bursting out of this zone. So in this particular case, the fact that we have 1, 2, 3, 4, 5 candlesticks, and the fact that the manner in which price has moved out of this zone is with a huge rally that is characterized by very long candlesticks, then we can consider this to be a supply zone. So in this case, we are supposed to mark our proximal line based on the basing candlesticks. So these three candlesticks, so this is the first one. So this is the first candlestick. This is the second candlestick. And this is the third candlestick. So in this case, we have a supply zone that is composed of a rally. So initially the market was making a rally to the upside. So we refer this to as a rally, a base. So we had formation of basing candlesticks. So these three candlesticks, so we have candlestick 1, candlestick 2, and candlestick 3 are what we are referring to as basing candlesticks. After that formation of basing candlesticks, we have a drop. So this structure is referred to as a rally base drop. So in this case, you would base your proximal line on the body of the candlestick, the body of the basing candlestick that has the lowest level in terms of body. So if you look at these three candlesticks, this is the candlestick that is on the lowest level. This is the basing candlestick that has a body which is on the lowest level. So the lower side of that body is where you should base your proximal line on. When it comes to distal should be based on the tip of the basing candlestick that has the highest wick. So if you look at these three candlesticks, the second candlestick has the highest wick, and we should therefore place our second line, which we are calling distal line, along that zone. So once you've marked this zone, you basically want to have the price making a rally to the downside, but your interest will be triggered once the price starts to rise again. So as the price continues to rise, your interest will be triggered to check on that particular asset the point at which market will get near the area which you had marked as supply zone. So when the price comes to that zone, ideally what you want to see is whether a price will react favorably towards this zone. So like in this case, you will notice that the point at which the market came back to this zone, the market just pierced this zone. Then we had another rally to the downside. So our intention to check on the price of this asset once price has risen back closer to an area which we have marked as supply is so that based on how the price reacts along that supply zone, we can be able to get into a trade and risk a very small amount of pips on that trade, because we will be targeting to place our stop loss a few pips above that level. And actually what most traders do, they place orders around this level, and once price comes to this level, the pending order would be triggered and the trade would be activated. Then price would actually continue to move to the downside. And as you can see, we only had 3 candlesticks piercing this zone. So if you're talking about an hourly chart, for example, it means that price would actually come to this zone and last on this small range within 3 hours before taking a huge movement, which is quite significant, to the downside. And as you can see, we had a very extensive move to the downside, and this is what this is the move that we are actually targeting to capitalize on. The next example of a supply zone is a structure which is referred to as a drop. Then you have a base, then you have another drop. So in this case, this form of trading is best suited to instances where you have a trending market. So in this case, you'd be looking to look for such setups along a downtrend. So ideally, you're looking for instances where you'd have the price dropping. So you want the price to drop, then you are targeting to have a very small retracement to the upside. So that retracement is marked by this bullish candlestick that is here. So the price would retrace upwards a bit before the downtrend has continued. So along such areas, you would want to mark such an area as a supply area, because what normally happens on a downtrend, the market will not go in a straight line. So you will have formation of market moves in a zigzag manner. So you will have formation of lower highs, so these are peaks and they are referred to as lower highs. The market will also form dips. So the dips are referred to as lower lows. So what happens is that as the market forms lower highs, like in this case, if we were to draw our supply zone along that area, so if you were to base our supply zone along this lower high, ideally you would be targeting to have the price making another drop. After the market has made another drop, you'll be targeting to see whether the retracement that will be formed will see prices reaching an area which you had marked as supply zone. So in this case, if price was to rise back with a huge retracement to reach an area which we had marked as a supply zone, so this is supply zone. So if this retracement was to rise to reach this zone which we had marked along this area, we would be targeting to get into a sell position along that zone, hoping to have continuation of price to the downside. So it does not happen always, but when a huge retracement has happened, you will notice that you can get into a very nice position and capitalize on the existing downtrend. When it comes to demand zones, you can have the market forming a drop. The market would then form a base and the market would form a rally. So such a structure is what we are calling drop base rally. So with drop base rally, ideally you are targeting for situations where the market has reached a particular level. The market forms very few candlesticks, but upon formation of those few candlesticks, you want a situation where the price has formed a very huge rally emanating from that particular zone. So in this particular case, we would regard this to be our basing candlestick. So this doji would be our basing candlestick. And these are the lines that we are calling extended range candlesticks. So in this particular case, we would base our proximal line on the highest level of the body of this particular candlestick. So this is our basing candlesticks. So if we had more than one basing candlesticks, then we would basically check on the candlestick that has the highest level. But since we have only one basing candlestick, then we would base our proximal line along the highest level of the body of our basing candlestick. So you draw your proximal line along that level, and the distal line would be based on the tip of the basing candlestick that has the lowest level. So the tip of the basing candlestick that has the lowest level. So in this particular case, we only have one basing candlestick. So we will place our distal line along the tip of the lower wick of that particular candlestick. Once you've drawn your proximal and distal line, you then extend those lines into the future, and you'd be targeting the point at which the market will come back close to this zone. And once the market gets to this zone, if that will be the first instance, that is what we were regarding to be a fresh zone. If this is the first time that the price is coming to this zone, approaching the same zone where you had this huge rally, we would regard that to be a fresh zone. And we were saying that a fresh zone is likely to yield better results, because the reasoning behind supply and demand zones is that the assumption or the notion that you had price leaving this level with huge extended candlesticks, it was caused by an imbalance in the market. You had a lot of pending orders lying along that zone, and those orders were not fulfilled. So traders would be waiting for the price to come back to that level, so that they can be able to fill orders which were not fulfilled. So these zones are targeted by institutional traders, and as you might be well aware, institutional traders trade in large volumes. So they don't care too much about how long it will take. All they care about is to get into a price that they would consider to be very discounted. So these zones offer that, and if that zone is very fresh, then it means that you might have a lot of buy orders accumulating along this zone. And once price gets to this zone, the assumption is that your trade will be triggered. So ideally, you'll be placing your buy pending order along this zone. There's a high chance to have your buy pending order to be triggered. Then the assumption is that the price will again make a U-turn and rally to the upside. So that's the whole intention. So we will be waiting to have a price coming or price approaching this zone in order to see how it will react along this zone. And our target will be to have our pending order executed, and that will be a buy pending order, to have a buy pending order executed at this zone before the price has rallied back to the upside. Then lastly, we have another structure which is rally base rally. So rally base rally would happen when the market is trending to the upside. So as you're well aware, along an uptrend, price will tend to form higher lows. So the dips are referred to as higher lows. And it will also form peaks, which are referred to as higher highs. So these are higher highs. And these are higher lows. So this is a higher low. And we have our last higher low there. So in this particular case, we are looking, if you are along an uptrend, the other structure that you can trade is rally, base, rally. So in this particular case, you will notice that we had price making a rally to the upside. Then there was a short retracement to the downside, which is marked by these basing candlesticks. So this red bearish candlestick is marking a short retracement to the downside. Then we have another rally to the upside. So with such a structure, you can place your proximal line based on the highest level of the candlestick, of the bearish candlestick. So you'd place your line based on the highest level of the body of that candlestick, and you'd place your distal line at the tip of the lower wick of the bearish candlestick. So once you've marked that zone, you'll be checking, or you'll be waiting to see whether in the near future the market will make another retracement to the downside. And as you can see, in this particular case, the market made another rally, then it made a drop, and this candlestick actually touched our demand zone. So this candlestick actually pierced our demand zone by very few pips. So the thing is, by the time the market is retracing backwards to approach a zone which you have marked as demand, you'll be targeting to see whether price will pierce into that zone. And once the price has pierced into that zone, since the price will not move quite extensively to the downside, you'd be looking to have your buy pending order triggered along that zone. Or if you're working with a lower time frame, because again, supply and demand zones work on all time frames. If you're working on an hourly chart, for example, after you've marked this zone, you have 1, 2, 3, 4, 5, 6. So within the next 6 hours, price has retraced back into our zone. So if you're monitoring the markets on the 6th hour, when the price has gotten back to a zone which you had marked as demand, you can actually place a buy position, because on lower time frame, like if you move to 15 minutes time frame, it means that this candlestick will have 4 candlesticks. So the last candlestick to touch this zone will enable you to get a very nice trade that will see you capturing this extended move that follows shortly after. So the intention is to either place a pending order along this zone or somewhere close to the proximal line. So your pending order will be triggered once the candlesticks pierce this zone, and your stop loss should ideally be below the distal line. So the intention is to have your order triggered once the price comes shy of this zone, or perhaps when price has pierced this zone. And since those will not be very many pips, you'd want to have your trade triggered and have the price making a huge rally to the upside. So you will notice that your risk to reward, the amount of risk that you might be taking, will be very small, but the reward is quite huge if you can be able to master how to find these zones. So what are some of the candlesticks that characterize such zones? So since we've seen that the extended range candlesticks should be quite long, you want to have manifestation of extended range candlesticks that comprise either engulfing candlesticks. So an engulfing candlestick is a candlestick that would tend to be very long. It basically overshadows 1, 2, or more candlesticks that precede it. So the candlesticks that are formed prior to the formation of an engulfing candlestick. So this is the candlestick that we would regard to be engulfing. It tends to overshadow candlesticks that come before it. The candlesticks that precede it, that candlestick would overshadow it. So it would swallow the whole candlesticks that have been formed before that candlestick. So these zones are characterized by either engulfing patterns, where we have long engulfing candlesticks forming, or they can as well be marubuzu candlesticks. So marubuzu candlesticks are candlesticks that have very long bodies with very small or non-existent wicks. So marubuzu candlesticks tend to have very long bodies with very small or non-existent upper wicks. So such are candlesticks that would help you to identify such zones. Now, how would you differentiate between supply and demand zones? So when it comes to support and resistance, these are levels where you'd have price retested for a number of times. On the other hand, when you're talking about a supply or demand zone, our intention is not so much to check how many times that level has been retested. Our intention is to look for areas where price make huge rallies towards a particular direction. So our interest is to see prices making or candlesticks making a huge rally either to the upside or to the downside, and that is what would constitute a supply or demand zone. So demand and supply zones are best if they are traded based on fresh zones. So if these areas have not been retested, then a fresh zone or the first retest would offer you the best results. So price exits supply and demand zone very fast with extended range candlesticks. On the other hand, support and resistance is marked by consolidation. So when it comes to support and resistance areas, you tend to have a lot of candlesticks forming along that zone because prices are being accumulated along that level. So unlike supply or demand zone, which we have said that we should have around 2 to 5 candlesticks for a supply or demand zone to be considered to be a very strong zone. Support and resistance, on the other hand, may have several candlesticks forming within that zone or within that level. So those are the differences between supply and demand and support and resistance. So I will now rush to the trading platform to try and give you an example of a chart where we have good examples of areas that you may consider to be areas of interest. So if you look at this chart, this is a 1 hourly chart, New Zealand dollar, Swiss franc. So how you are supposed to identify these zones, of course, it would take time for you to master them, but ideally what you're supposed to do is to have a naked chart and you try to identify areas where price has reached and a huge rally has been formed shortly after. So if you look at this particular case, you will notice that at this level, we had an example of a rally. So price rallied up to this level. Then we had two basing candlesticks. So we have these two bearish candlesticks forming here. Then the price burst. So after we based with two candlesticks, the price burst with long bearish candlesticks, and the price made a huge rally to the downside. So this supply zone is one of the structures that we've discussed, and we have said that you can regard it to be a rally, base, and a drop. So first of all, you have price making an extended move to the upside. Then you have basing candlesticks forming. You have candlesticks that are moving sideways. Then that is followed by a burst of price to the downside. So that is a rally, base, drop. So what you're supposed to do is to, maybe I can try to magnify this chart. So in this case, what I did, I drew my proximal line. So this is the proximal line. So we say that on supply zone, the line that is below is called proximal line because it's the line which is closest to the current market price. So this is where the current market price is. So we would place this line, which you are calling proximal line, based on the lowest level, based on the candlestick, based on the basing candlestick. So when you talk about basing candlesticks, we are talking about this red candlestick and this one. So these are our two basing candlesticks. So we would base our proximal line on the candlestick that has the lowest body. So the second candlestick has its body lower than the first body. So we would drop our proximal line along that level. So this is our proximal line, the lower line, since it's the line which is closest to the current market price. Then we would base the distal line based on the highest level of the basing candlesticks. So if you look at these two basing candlesticks, the first one has the highest peak. So this is where we will base our distal line. So again, you will pick a line and draw it. So I think we can try to draw that. So how do you draw? So this is MT4. So you will come to this bar, you click horizontal line. We start with our proximal line. So it's based on the lowest level of the body. So we drop the line there. Then our distal line will be based on the peak. Once we've drawn that, we can then shade that region. So you can shade that region in order to mark it as your supply zone. And we will extend this line into the future. And by marking that zone, ideally, we want to check whether, as the price continues to drop further down, is there a time when the price will come back to this zone? So if there's no time when price has approached this level, this is a level which we are calling fresh zone. So in this particular case, you'd be intending to have price coming somewhere inside this zone, and you'll be trying to check whether upon entry along this zone, whether the price will just pierce this level and make a huge movement to the downside. So in some cases that might happen, in some cases it may fail, but when it happens, you can get a very good trade because your risk will be very minimal. You'll be intending to place your stop loss slightly above that level, and you'll be looking to get into your trade somewhere close to the proximal line, somewhere close to the lower line. And once that trade has been triggered, you will notice that price is likely to burst with a very huge movement to the downside. We can go further backwards and check whether we have another critical level where price has made such a huge rally. So as we go backwards, you will notice that we have another zone which we can mark. So we have these extended range candlesticks. So we have two. So we have these long extended candlesticks. So we have two of them. So that might qualify to be an area of interest. So again, you will take another line. So you mark your distal line and you mark your proximal line. So our proximal line will be based on this blue candlestick. So once you've placed your line, you will notice that if you check backwards, this area has been retested. So this was a retest. This was actually a retest of this zone, because again, you can see that here we had two long candlesticks dropping from this level. So this was a retest of this particular zone. So if we move our distal line and proximal line to this zone, you will notice that had we drawn this level earlier, we could have been able to capitalize on this trade because as you can see, if we had marked this zone, we could have been able to get this retest. So price rallied, it made a base, then it made a rally by two long bearish candlesticks. And when it dropped, the point at which price rallied back to that zone, you will notice that candlesticks were just piercing this zone. Then afterwards, we had a significant rally to the downside. So these retests could have been a case where we were trading our initial supply zone. So this was another supply zone which you could have capitalized on. But as you proceed to go backwards, you will notice that we have another zone. So the next zone is this one. This is another beautiful example of a supply zone, because as you can see, we have two long bearish candlesticks bursting out of this zone. So we have the first extended range candlestick and the second one. So in this case, if we had marked this zone, so how do you mark it? So this is our proximal line, and this is our distal line. So this area is marked. So if you check forward, you will notice that this level has not been retested. So what do I mean by retesting? Retesting is to have price making a rally to pierce that zone, then have price reversing to the downside. So as you can see, this is a fresh zone. It has not been retested yet. So that is why I've left it marked, because the intention will be to wait in the near future until such a time when price will come back to that zone. So as a matter of priority, I'll be waiting to see whether the price will come to our first supply zone. So if the price retests this zone and have a reversal to the downside, then that would offer a nice opportunity to sell. However, it doesn't mean that it's a must to have this zone retested. So price can come and burst upwards and proceed to move higher and higher. So my second level of interest is therefore this particular zone. So this is our second supply zone. So if this zone is broken, I'd be looking to see how the price reacts to our second supply zone. So should it happen that price will come to this zone and form some piercing candlesticks along this zone, should it happen that price will form two bearish candlesticks shortly after touching this zone, then that is the point at which I may consider to get into a sell position, targeting to have the price dropping to this level first. And if this level is broken, then I'll be targeting to have price coming back to test where that trend began. So we are talking about this particular zone. So your first target for take profit can be this zone. In a case where we will be retesting the second supply zone, so you'll be targeting to have price piercing that zone. So you enter your order. Your first take profit target will be this zone. If the price retests this, if the price retests this zone and it happens to initiate a reversal to the upside, then you can close your trade. But if the momentum will be great, you'll be targeting to have your second take profit target to be where that trend was initiated in the first place. So that is just but an example of a rally, base, and drop, where we have been able to identify two supply zones, and these supply zones have not been retested. So the first one is this. We are yet to have the price retesting this zone. So we will know whether we will get into a sell position once price comes to this level. So if it reverses, then that offers a nice opportunity to capture an extended move to the downside. If this level is broken, then we will be targeting to see how a price behaves once it gets to our second supply zone. So as you can see, this level has not been retested. So when the price dropped and rallied back up, this candlestick did not touch our supply zone. Neither did it happen when the market made the second rally to the upside. So this zone is still fresh, and we can wait for the market to have. We can wait until the market has rallied back to this zone to see whether it can be retested and offer us a nice opportunity to place a sell position. So with that, we come to the end of our today's session. So I hope you've been able to learn something. So what I'd urge you is to try and practice that. Try to practice that on different time frames. So this method can work on any time frame, and it actually can supplement confirmations depending on how you trade. So depending on your strategy, this can act as an additional form of confirmation. So the more confirmations you have, or the more confluences you have along a particular zone, the higher the probability to have that trade moving towards the direction that you're hoping. So with that, we come to the end. I wish to thank you all for finding time to attend today's session. So I'll now open the floor for a few questions that you might have. So Joyce, you're asking whether time frame matters. So as I have stated, you can look for these levels along or within any time frame. So it does not matter the chart. But what you should bear in mind, if you're analyzing on a lower time frame chart, the trade setup that will be formed will not form a huge range in terms of price movement. So short term or lower time frames tend to offer a very short range in terms of price movement. So the setups that you would identify on a lower time frame, the range in movement will be quite small. On the other hand, when you're doing your analysis on a higher time frame, getting such setups would take so much time, but those setups they take time to form. It will take long to form, but once you've identified such a setup on the basis of a higher time frame, that setup would have potential to generate a very huge movement in terms of price range. So that's the difference. It's just that with lower time frames, you'd be targeting to generate fewer pips, but when you base your analysis on a higher time frame, you're targeting to capture a very huge movement in price. Otherwise, it applies to all time frames. So I think I've also answered you, Isabel, because you are asking what time frames one should use. So you can use it on any time frame. So Ondieki, you are asking, during a trend, how do you decide which pullback becomes the base? So you basically need, even if it's one candlestick. So as you have seen in this example, when you're along an uptrend, so this is an uptrend, you just need to have a pullback. So it can actually be a single candlestick. So like in this case, you will notice that though the pullback was constituted by one bearish candlestick, the fact that we had marked this zone, so as I have stated, this is our proximal line because this is our price. This is where the price is. So the line closest to the current price is what we are calling proximal line. So you'd look at that red candlestick and you'd base your proximal line on where the body ends on the upper side, the opening price of this bearish candlestick. Then you'd mark the distal line along the lowest level of that candlestick or the tip of that bearish candlestick. And as you can see, in as much as we only had one bearish candlestick, the market was able to rally upwards and we had another retest shortly after. So the fact that you would have marked this zone, you can easily be able to get a nice trading opportunity and have the price continuing with the trend. So the point that I'm trying to put across is when you have an uptrend, when you're looking for rally, base, and rally, you can try to use higher time frames. So for example, you can try to use 4-hourly charts or daily time frame charts because these three candlesticks on a daily time frame would be marking 3 days. So once you mark that, the fourth day, you can move back to a lower time frame candlestick, like a daily chart, and wait for the time when the sorry, you once you've marked this level on the basis of a daily time frame chart, on the fourth day, once this level has been broken, once the proximal line has been broken on the third day, you can move to an hourly chart on the fourth day, and you'll be trying to establish whether this daily candlestick on the fourth day will have some of its hourly candlesticks piercing the proximal line. So in short, when you have rally based and rally setups, they are best suited to identify them along higher time frame charts, because you're more likely to have high quality trade setups. But when you're looking for instances where you'd have a reversal, so in the case of a reversal, like drop base rally, such setups normally take time to form, because the fact that you'll have, let's assume for once that we had marked this level as our demand zone. So you will notice that you will have to wait for all this period until such a time price is to come back close to this level. So this amount of period might be long. So when it comes to setups where you're looking for reversals, then it's best suited to use lower time frame candlesticks. I mean lower time frames, like let's say 1 hourly, 30 minutes, or even 15 minutes charts. But when you have a consistent trend, either moving to the upside, like in this case, you can use 4 hourly charts and daily time frame charts, because all you want to see is a small retracement, like in this case to the downside. And as you can see in this case, if you are on a daily chart, it would take you 3 days. Then within the next week, this level would be retested, and you'd have a very nice trade that you can be able to hold for several days. Again, if it was on a 4 hourly chart, this would be a total of 12 hours, because each candlestick would be representing 4 hours. So once this level is broken, you'd wait for 1, 2, 3, 4, 5, 6. You'd wait 1 day to have price coming back to this level, and upon retest, you can easily get another trade that will give you a very wide margin in terms of movement. So to answer you, when you have a consistent drop in price, try to use higher time frames to identify small retests. But when you have price forming very huge retracements, then you can try to look for reversals on the basis of lower time frame charts. So George, you're asking what is the relationship between supply and demand with support and resistance zones. So as I have stated, with supply and demand, you're basically looking for scenarios where price bursts with a huge rally. So that is what would characterize a supply or demand. So a demand is a case where you've had a burst in price rally to the upside. So ideally, you would mark that zone with a proximal line and a distal line, and your intention is to wait for the price to come back to that level to see whether it will be retested. As for support and resistance, as for support and resistance zones, these are zones where price can be retested more than one time, and you cannot tell how the price will behave until the price has come back to support area. But when you're talking about supply and demand, a situation where you've drawn, or a situation where you've identified a demand level, ideally you're looking for a buy position. So this is pretty definitive. With support and resistance, it's not quite definitive, but with supply and demand, it's quite definitive, because if you've identified a demand zone, it basically means that when the price comes back to that level, there is a high possibility that there are some buy pending orders which were not able to be fulfilled when the price rallied out of this zone. So ideally, you know that a demand zone would be giving you an opportunity to get into a buy position. So this is well defined. When you talk about a support level, for example, this is mostly a level that has been retested for a number of times. So the more times that level is retested, the stronger we consider that level to be. So with demand and supply, we are saying that a fresh retest, so a fresh retest, or when the price comes back for the first time to retest that zone, that offers the best opportunity, because we are trying to see whether pending orders which lie along that zone, whether they will be fulfilled and have the price rallying back to the upside. In case of a supply zone, we are basically trying to see whether the price will come back to that zone and have the unfulfilled sell pending orders met at that second retest, or that first retest. So with supply and demand, the first retest is what we are considering to be to offer the best opportunity to trade. When it comes to resistance and support, the more an area has been retested, the stronger we consider that level to be. So that is the difference between support and resistance with supply and demand. Supply and demand are more definitive. You already know before a retest has happened what you intend to do. But with support and resistance, traders basically try to gauge whether the price will break or whether the price will reverse along such zones. So those are the only questions that you have posted. So I hope you've been able to learn something. So kindly try to practice that on your charts, at least on your demo account. And you will notice that with time, you will be able to perfect on how to trade using supply and demand zones. They can actually complement your existing strategies in order to identify the right setups to trade. Otherwise, I wish to thank you all for finding time, and I look forward to interacting with you in our future sessions. So enjoy the rest of your afternoon.